All right, cool. So let's get started since it's, I guess, 2 o'clock. So welcome everyone to today's webinar where we'll be discussing Division 296 and a smarter way of approaching it. We're going to be discussing practical tools for BGL users. And joining me today is the CEO and co-founder of Smarter SMSF, Aaron Dunn. So before I hand over to Aaron to go through today's session, just a couple of housekeeping, matters to cover off. Today's session is being recorded, so all attendees will receive an email with the link to the recording as well as a copy of the slides. At any point during the webinar, feel free to type in your questions to the Q&A window, and Aaron and I will go through answering them, either progressing through today's webinar or at the end. So having said that, over to you, Aaron.
Excellent. Well, thank you, Anthony, and welcome everyone to today's session, which we are taking a slightly different tact around Division 296. No doubt you've heard this topic ad nauseum in recent times, where we have been really focused on the technical aspects of how these laws work. So today we're taking a more practical focus because a lot of us have been busy with a lot of different things. So AML, I can think of, payday super, the budget and so forth. So we want to start to turn our attention to what we do next. And if you do have clients that have TSBs over $1 million or even approaching it, then we do now need to start talking to them, or them hearing from you more importantly. And as scary as it sounds, we know that this starts from 1 July 2026. And it's only actually a few weeks away. So part of what I want to do today is to only touch on the technical aspects, but put it into some more context for you. So different sections that take you through what you need to be doing and when you actually need to be doing it. So there are a few dates I think that are important to start with here. And first of all, it's understanding when these laws are starting ordinarily, and the fact that the conversations that we need to be having with clients that are impacted probably need to be starting from now, or if they haven't already started. We've always been talking about the fact that we don't want to go early with this because we knew we've gone from version 1 to version 2, and even to the extent of the federal budget where we might have been moving monies around out of super into maybe family trusts. And of course, we know what has transpired in the federal budget that again just needs to recalibrate the thinking about how we do things going forward. We've got dates like 30 June 2026, which are really important, from a decision around whether we make an election or not for capital gains tax purposes for Division 296 tax only, and we'll sort of touch on that. And then these other dates in here really deal with the end of the first year, that transitional year where we might be looking from a TSB point of view at the end of financial year, or where a member dies in year 1, they're not going to be impacted by Div 296, through to the introduction, I guess, of the measures in their full force from 1 July 2027, where we have some integrity measures that are relevant for self-managed super funds around the higher of TSB rule to determine what is our TSB reference amount. So there's a lot of stuff there for us to work through, and no doubt you've heard from BGL and whether it's been the SMSF days that we've ran and so forth about the technicalities and the things that we need to be aware of. But what I want to really focus on today is get you now looking at what your communication identification looks like with your clients. And we're really going to focus on these 4 key areas. So what you need to be doing to identify who those clients are and really put them into different categories. So naturally, you've got what we know as our in-scope members, those that have money above 3 million, those that have monies above 10 million, but also contemplating those that could be impacted in the future. Now, that's just not people that have a balance of 2.7 million. We can very clearly start to identify within our client base those on a survivorship approach. And what I'm talking about there is, say, in a husband and wife situation, we end up in a position whereby the survivor ends up with an excess amount and therefore would be subject to Division 296. We also know that people might have things like insurance, or they might sell their business, and these things we need to plan for in the future as those balances grow over time. And then we move into the communication approach, because it's, what do you actually tell them? Do you tell them, verbatim what's going on in these laws? And we need to communicate this in a way that makes them understand, but doesn't overwhelm them with information, because there is so much to unpack with the introduction of a new law. So that what we want to do is that they can just sort of take things through in bite-sized chunks. And that's really what we want to ensure that we can do through this communication approach. And once we, I guess, start that communication, the clients are then going to want to know, well, how does it actually impact me? So from that point of view, what does the exposure look like, or what's the potential exposure look like in the future? And what sort of things should I be doing to actually help make a difference to my overall financial position here? And again, we've seen a real shift in this discussion in the past few weeks since the government announced changes in the federal budget. And even just looking at some of the modelling since that point in time, it becomes a very different conversation if we're going to be moving that money into, say, a family trust, compared to now retaining it in super, where we've, say, got a balance under $10 million for Division 296 tax purposes. So that modelling is going to become really important to revisit that. Or if you haven't visited it yet, then we have a range of other considerations we need to now factor in. And then once we get through that approach and the client understands it, you've been able to model what the changes or considerations need to be, we then move into, what do we actually have to execute on here? What are the documents we need to put in place? How do we actually execute and put in place the things that are going to make a difference in the mind of your client? And really, what, between myself and Anthony today, we want to highlight, I guess, how both of us are going about creating tools and solutions for you to be able to work through these 4 different steps. So how we're going to break this down, and how I've really broken this down since these laws come out, is to really look at what we see as 3 tiers to this with your clients. And you'll see in the communication that we have, we really do focus on these different tiers that are relevant with your clients, because there's clearly more urgency to be talking about this as an issue with clients that have balances above 3 million, and even more so where those balances are above 10 million. So there is more immediacy around some of the decisions that you've got to make, because we know from 30 June 27, that's when the liability would be trickling in. And therefore, we only have, in essence, 12 months or so to not only advise and model, but then implement. And that could be through redeeming assets down, it could be transferring assets, whatever the case may be. We need to go through a period of time. And as we know, these years seem to be going much quicker. So understanding all the bits and pieces to those tier 1 clients is something we need to really get on top of. But then as we work through from tier 1, we move into tier 2, we need to make sure that these clients are aware of the potential risks of them moving into a Division 296 threshold. So again, this is something where it might be just through good performance in the fund that their balance through both contributions and other inflows, that they're going to push up to that $3 million threshold, and then at some point become exposed to that. Now, yes, there's going to be indexation linked to CPI across both the $3 and $10 million threshold. But in reality, we would be expecting funds to be outperforming CPI. So more than likely, we're going to see those clients come in. But there's also these event-driven things, as I've already touched on before. So it might be an insurance event. It might be a CGT cap amount that comes into the fund. You're not necessarily planning for the insurance event, but you can quite clearly identify if you've got a client that has, $600,000, $700,000, $800,000, and then they've got a $2 million policy. If something happens, they can very quickly move up into that band of Division 296 tax. So again, highlighting these things, making sure your clients understand that they're nearing the threshold or might get pushed into a threshold in a particular circumstance. And then the other one is around the estate planning risk, which to me is the big sleeper in here, because whilst they're not in scope now, simply by transferring benefits between the spouses here. And I give a simple example of 2 million and 2 million. Then quite clearly, both are under. One dies, one ends up with $1 million over. And that is clearly something that a message we need to get out to people and the steps that we need to do to accommodate that as well. So this is something that we built for our SMSF Day events to really help people understand all of the steps to go through to determine how a Division 296 tax liability will come about. And this is the first page, and it's changed along the way. But in essence, really what this enables us to understand is whether we have clients that are exposed to it or not. We start at the beginning there with the exclusions. So are there any parties in here that are excluded ordinarily from these requirements? So in that regard, it's things such as child pensions or structured settlement contributions. And they were pretty much what was excluded previously in version 1 of these rules. But then it moves into the things like TSB reference amounts. So these are new terms that we need to be aware of now off the back of these revised measures, because for SMSFs, it is absolutely critical to understand that from the year 2, so 1 July 2027, as an integrity measure, the government has now introduced a higher of TSB amount that will ultimately become the reference amount for determining the liability. So if we have a client that ultimately is higher than $3 million in that year, they're not only caught once, they're caught twice, because they might be caught on a closing balance in 1 year, but they're going to be caught in an opening balance in the following year. Now that relief, that's something that happens from year 2. So we do have this transitional measure or relief that is available in year 1, and you can see that's why we move to the left-hand side below step 1 there. And then we have to then understand the implications of death. And really, the driver to these laws really shifted when the unrealized capital gain stuff moved from being a tax that they would collect along the way to a tax that they're going to actually derive through the death of a member. And they make no apologies for that, because that's ultimately what we wanted. So by virtue of saying it's not fair to tax unrealized gains, we will see clients that are going to end up in a worse scenario in this situation. But the reality is they're going to have the cash flow to be able to facilitate as well. So then, again, we sort of just keep moving through here to work out whether we have in-scope or out-of-scope members. And then once we've determined that a member is in scope, we have a number of steps that we're going to need to go through. And there's some steps that the ATO is going to be involved in. There are some steps that you're going to be involved in, and using your BGL data to aggregate that. And there's going to be steps that the actuary has to be involved into. And then ultimately it's going to come back to the ATO again to determine the liability. So there are many moving parts now in this, and I'm going to talk to the regulations a little bit more shortly. But the reality is there's, the ATO has a role to play as the collector of all that information to work out whether we have in-scope members or out-of-scope members. We then have a role to determine not only fund level earnings, but then looking at how that is attributed to a member. We involve an actuary in that process, and then we report that information back to the ATO to determine what that calculation looks like. So, Anthony, I'm going to just get you to provide some commentary here, because I think that one of a real critical ingredient to this is using your data within Simple Fund 360 to identify the things that are relevant and to really fast track that conversation that you can actually have with your clients. So I'll hand over to you here just to talk about the importance of bringing all that stuff together.
Sure. So just in terms of the tiers that you sort of identified on the previous slide, sort of those who are approaching the 3 million, those above the 3 million, and those even above the 10 million sort of total super balances. So within Simple Fund, so if I get you, Aaron, to move to the next slide, I think you've got sort of a screenshot of our insights dashboard. So that's essentially where you'd be looking into. So if you go into our insights dashboard, on the left-hand side, you've got all these I guess, options to filter on. And if you scroll down, one of those is total super balance as at 30th June 2025. So this will get updated once we take over to the new financial year. But you can still run this as at 2025. And you've got different thresholds that we've earmarked for you. You could, for example, select the one that says 2.7 to 3 million, as I've sort of indicated there. But what you can actually do is you can actually update that amount to be any TSB threshold that you want to search across. And once you hit apply on the right-hand side of that screen, it will filter out all the funds that have a member that fits that, let's say, threshold that you've selected. So you've automatically identified which funds potentially have members that sit within that total super balance that you're looking for. So that's your first starting point to identify which funds are potentially impacted.
Very good. And I think that goes back to the commentary I made before around, thinking through your tier one and your tier two and your tier three sort of clients, because, yes, as you can see there in the sort of bottom left corner of the screen, there's some, I guess, some ranges there for you to work through, but equally, it will allow you to, in a more granular sense, get an understanding of not only what's happening within the fund, but then get the detail that you need at the member level as well there. And I think, Anthony, then once you've got that, and I presume we can just export that out in CSV or something to be able to utilize.
Yep, and there's actually a question that came through just now as well, saying, does it pick up if the member is a member in more than one fund? So if both those funds are within simple fund, then yes. We also do have a mechanism to put in external TSBs as well. So that's within the transfer balance screen. So that's where you'd go put in those, if a member is a member of an industry fund as well, so that our calc is fully sort of up to date. That's where you'd go enter that information. But yeah, it essentially allows you to, let's say, calculate everything within the software itself. Yes.
So then, I guess, Anthony, the next thing is getting your questions answered, I've called it there. So this is where, I guess, one of the real strengths of Simple Fund 360 is the fact that we can look to the data and actually then start to draw out the answers that we want to find, or ask the questions that we want to through the Ronnie AI assistant.
Yep. So what we're using is, so we've got a Division 296 sort of assistant, which we implemented almost, I would say, 6 to 9 months ago, just to give clients an idea of the potential impact based on the 2025 data of those funds with members that are approaching that 3 million and 10 million caps. It assumes sort of a 5% growth, and it calculates based on that as to what the potential tax or Division 296 tax is for each of the members. It's sort of it's a process that's run at a fund level. So you can, like I said, identify those funds that are potentially impacted, then go into the Ronnie assistant and sort of get those calculations. That'll give you the detailed calcs as well, give you the method to our madness of sorts. It'll give you the full step by step, and yeah, essentially tell you what our assumptions are along with the final potential tax calculation as well. So yeah, it's all available for you.
Yep. And so I think that process of identify and segment, and as I said before, thinking about who are those in-scope members now, our tier one clients, and then who are those that might be approaching, and then finally those other ones that would be relevant that we think could be impacted that need to be communicated in any event. So then it comes into, well, we have the list. Now, what do we actually go about doing? And this is where it all comes down to, how are we going about communicating this with our clients? How are we going to be modeling the numbers that we need to be doing? And then what paperwork do we actually need to be able to put in place as well? And one of the things that we've done now at Smarter SMSF is that we've built a specific Division 296 tax hub to actually deal with those elements of client communication and do some of that calculation. And then, of course, being a document business, we are working on a number of key documents to be able to support the implementation of these reforms. So this next step here about client communication, what we have done on our site is built 7 resource categories around Division 296. So all in one key destination that provides you with a range of tools to get FAQs on different subject matter that relate to SMSFs and the impact of these laws. We've got a legislation tracker around where the Act is, where the ATO's guidance will obviously be once this has been finalised, the update or status of the regulations, which are still in draft form at this stage. We are expecting those to be registered prior to the 30th of June. Treasury has given that indication that that will be the case. And then in addition to those things, what we then have is these advisor and client resources and fact sheets and calculators and tools to be able to navigate your way through. And as I touched on before, our SMSF documents. So what I'm going to do here is just go through what some of this ultimately looks like. So, and this fact sheet concept that we put together, and you can see all of the different fact sheets that we have down the right-hand side here, are allowing clients to be able to take sort of piece by piece to this topic of Division 296, because we've already run sessions on this which are half day, and that's for a professional, let alone trying to do this for a trustee and explain it. So to understand the differences of this, but also doing this for not only the client, but actually provide this for the advisor as well. So these fact sheets that you can see here are in essence white labeled and enabling you to look at these and utilize these in a way in which it suits you. So just put up on the screen here, this is the fact sheet 4. It comes in a Word document and you can fully customize this in a way that suits you. So again, what does the election do? The record keeping obligations, when you should make the election, so on and so forth. So very, very simple, only sort of in this instance 4 pages, but it's giving your clients some bite-sized chunks around how these laws then actually work. Now, from there, that what we want to do to complement these are then the communication tools. So what we've done here is we've built a whole range of white label templates, both in a client focus. So if you're dealing directly with the trustee, the ability for you to talk to those clients about those that are in scope versus those that are not yet in scope, and then those that what we call our survivor exposure. So that is where we have a circumstance, like I said before, 2 million and 2 million in a coupled situation. One of them dies, then they naturally get exposed to Division 296 tax. So we've done that at both a client level, but if you are a administrator or you provide services to a related advisor, use the word broadly because it might be with mortgage brokers, it might be with financial advisors, stockbrokers, and so forth. Again, we've built a range of letters to support them as well and to work through ultimately the different elements there. So again, I'll just go back to these letters, and what you'll see in here this time is that we've made reference here to then the fact sheet. So we're not writing full chapter and verse in terms of what you need to be doing and how you need to be doing it, and in essence writing something that would look longer than a statement of advice. This is then telling the client, we've identified you, there are things that we need to do, we've built a number of fact sheets and things to support you, and then let's organize a meeting, or we'll be in contact with you to be able to go through what that ultimately looks like. Now, to compare that to, sorry, if I go back to this one, if I go back to our advisor letter here, again, what I've just used is what we call our survivor exposure letter. So this is the fact that we might have communicated already with the advisor about the in-scope clients, but we've got these other clients or other cohorts of clients that we feel need some form of attention, and what that attention needs to be, we then highlight down in here. And again, this is where we use our Simple Fund 360 data to actually work out whether we need to make adjustments or not. So whether we want to ensure that we're going to maybe change reversionary pensions for example, whether we're going to be amending the deed if we need to amend the deed. But it highlights here, those different tiers. We use that data and we then go through and have that conversation with the advisor, who can then have that conversation with the client as well. So again, we make reference to the fact sheets and then ultimately how you, as that practitioner, can support that advisor do the work as well. So this is all ready to go and built to be able to support those that have those clients that are impacted. Like I said, whether it's an impact by being in scope already, or whether it's simply through the fact that there's a potential risk in the future. And we've even done it in a way in which there are those that just aren't in scope, but it's just worth generally making that available to them as well. And again, we've built some presentation content if people are having presentations that they do with their clients too. So this to me is what the workflow looks like overall. So it is about that communication. We can access the fact sheets and client letters that can be converted into email. It's totally flexible. We identify those that would be relevant to being in scope or the survivorship issues. We've written it in plain English, so we know superannuation can be complex. So we want to try and unpick those complexities. We identify those clients. We do the modeling. We use the data from Simple Fund 360 to do it. We look to take advantage of opportunities that exist within the law, such as the CGT election stuff. And then we move ultimately into an advice process. Now, many of you are saying, well, I'm not licensed to be able to provide advice. I understand that. That's where you may need to, if there are specific recommendations being made around adjustments to superannuation interests, well, that is potentially an issue that you would need to resolve. But providing modeling and providing advice around the numbers in here are not financial product recommendations as such. So you can certainly do some of the work that we've been indicating here. But if there are some recommendations ultimately being made around, say, a commutation, well, then quite clearly that moves into the advice framework. So you're going to need to be careful how you sort of step through that sort of thing. And then ultimately, once you've done some of that modeling, you've identified some of these issues, and then we can move into, in essence, that implementation, and the fact that if we do need to make adjustments for the deed, because we do have in-scope members, the fact that we might be looking at making those elections. So what do we need to incorporate into that election to ensure that it complies with what the Division 296 tax laws require within the Income Tax Assessment Act? The fact that if we've got pensions on foot, whether we're going to be making changes, say, to the reversionary status of those pensions. Are we actually formally commuting and repurchasing those, or are we able, under the governing rules of the fund and the terms of the pension, to be able to change that pension midstream? Again, there's a number of these things that we can do. And ultimately, this is not a do it one time and set and forget, because these rules, of course, allow us, or require us probably more to the point, to continue to assess the ongoing management of our clients' TSBs, and therefore the fact that clients could move in quite quickly to that Division 296 tax and be exposed by that. So I then now move into, in essence, the modelling. And this is where it becomes quite interesting for self-managed funds. And I spoke earlier about the workflow or the flow chart, a diagram from section 1 that we started with, because this is where it gets really interesting, is probably to say the word. So the way in which attributed earnings are assigned to a member of a self-managed super fund, which is very distinct and different from the fair and reasonable attribution calculation that applies to an APRA regulated fund. So this is, in essence, the obligation that we have under Reg 296-6503. I've already said to you before, these draft regulations are expected to be registered by the 30th of June 2026. And what we also know is the only thing that is holding these regulations up are some changes around defined benefit pensions. So the issues around the death of a member and the challenges that are going to be presented off the back of the Division 296 liabilities with death benefits will remain. And what I'm talking about there is that if we have a death benefit that ultimately straddles multiple years, then the TSB of a deceased member becomes zero at their time of death. However, the timing of when that benefit gets paid as soon as practicable will mean that the attribution of earnings will either be, if it's reversionary, the time when it clearly reverts to the surviving beneficiary. But if it is a non-reversionary, if they're in accumulation phase, then really the attribution of earnings are going to continue until that death benefit has been paid. So what that means is we end up with multiple years in some instances whereby the attribution of earnings will not only happen from the date of death for that relevant year, but if it happens also for the next year until the benefit's been paid out, and it could even be years beyond that. And once the benefit's been paid out, then in essence, all of those earnings are going to be attributed back into the year of death. And then we're going to see that information sent off to the ATO, and the ATO will then be the one that will determine the liability of that. Exposes executors quite significantly. There are clearly some concerns with how that's been drafted. The advice that we've had is we're not changing anything. So ultimately, it will be up to industry and the tax office to look at how that practically gets administered. So yes, the fun and games will certainly begin there, but it does highlight, as you can see in here, the way in which we're going to have to deal with how pensions are structured, whether we make changes or not, to the way in which those pensions might operate as well. So then we get to, in essence, this final steps 5 to 7. And really, these steps here don't change from what we already knew from version 1. The fact that we have a proportionate calculation, the only change is really that we have a proportionate calculation that deals with above 3, but to 10. And then we now have a different proportionate calculation that deals with 10. Important to note, though, that the extra 15%, so if we've got someone with a $15 million balance, it's 15 back to 3, which gives us 12, of which we then are multiplying that by the 15. And then we've got a 15 back to 10, of which we're then paying the additional 10 on it. So it's not just a stepped bit, 3 to 10. It's on that 7. And then separately, we've got to look at the total TSB, or the TSB reference amount, back to the 3 mil and then back to the 10 if that is relevant as well. So, and as I've mentioned, how and when it gets paid, especially in the event of death, is going to be quite problematic. But the ATO, as we can see here, becomes the entry point to this based upon that TSB information that we've sent them originally, but then they're also going to be the collector of it around the end of this cycle as well. So noting that in many instances, we will see the release of funds come back as we do, say, for a Division 293 liability. That member will be able to elect to have that released from the fund. And therefore, if we're in pension phase, for example, which I'm sure many of these clients are, you might not be releasing it that way. You might simply be better just taking it out as a pension benefit, for example. So what we've done at Smarter SMSF is we've started to build out a few different tools to help understand what this liability looks like. And there are some things within the AI that Simple Funds 360 you'll be able to do as well. We're building some integrations directly to be able to pull data down out of Simple Funds 360 like we do with many of our documents. But the idea here is that we've built out some ways in which you can not only calculate the liability, but sort of model out what that would look like as well. So I'm not going to go into the granular information of that today, but just to highlight that we have been working on a number of these at the same time to try and populate this information to ensure that you've got some robust information to have conversations. The other one here we're doing a lot of work on is our CGT election benefit modeler. So again, just looking at whether you should or shouldn't be doing that. But again, projecting out a comparison here between whether it has or hasn't been made quite clearly. Again, my view is that just about all self-managed super funds should be making this election by the due date, that due date being the 2026-27 SMSF annual return. That means we have different dates subject to whether those lodgements are on time or not. But the relevance of it now is that we are using our 30 June 2026 market values to determine that CGT cost base. Now, it is for all fund assets, unlike the 2017 reforms. We are required to choose it on all. It is an all or nothing approach. It is irrevocable in that decision that gets made. And it is only for Division 296 tax purposes, which then does influence the way in which the Division 296 fund earnings calculation works to determine the attributed earnings that the actuary will provide as well. So understanding the pluses and minuses that you will have inside your fund is going to be really important, because you are going to potentially have some funds, some assets in a loss position, but it still makes sense to actually run that CGT election to uplift for Division 296 tax purposes. And I'm sure, Anthony, you and your team contemplating all this and the challenges that are going to come with the fact that you're going to have another cost-based item that's going to need to be considered.
That definitely is the case. And something that we're currently working on for our upcoming release is a Division 296 CGT analysis.
Yep.
Um, I don't know if you just jump across.
Yep. Yep.
So this is just a screenshot of the report that we're currently working on. It's essentially utilizing the data that's currently available in the unrealized capital gains report, but it's sort of distilled to better sort of identify of those assets within the fund, which are in a gain position, which are in a loss position. It'll also identify if any of your market prices are not at 30th June, because this election needs to be made as at 30th June of this year, and essentially tell you, look, here's at an individual investment level how each of those investments or what the unrealized gain or loss position is, and then at a fund level give you what the net position is as well, so to better sort of, I guess, inform you in terms of whether or not you should be looking to make that election.
Yeah, absolutely. Because I think the other thing that's really worth noting, and it's the comment that I made here, a lot of funds, we don't want a situation whereby a client that is out of scope now is simply ignored, where, and I go back to my same example I've used multiple times now, where you've got a husband and wife, $2 million each, and then at one point in the future, the survivor of the two ends up with 4 million. And off the back of the 4 million, they then look to sell assets. And the question that should be asked then is, well, did you make that CGT election? And they go, what are you talking about? And off the back of that, they would have been eligible at this point in time, but it wasn't done. And so therefore, they are subject to the capital gain on parts of assets that were accrued before these laws came in. So even where clients are unlikely to be exposed to this, it still does make sense in a lot of instances to be able to do so. And again, I'm going back to those tier 1, tier 2, tier 3 type clients as really good examples of you being able to have conversations with them. Yeah, sure, if there's a couple, if you've got clients that might have $200,000 or $300,000 in it, they're in their mid 80s, there's no sort of other events that are going to happen that will throw more money into the fund that would expose them. Sure, you could ignore those, but if you've got, we used examples at our SMSF day where we had, they only had a couple of 100,000 in their fund between them, but there was a $2 million insurance policy in respect to death or TPD. So even though there was not large amounts of gains, there's no harm in making that CGT election now to ensure that there is only going to be gains incurred if Division 296 landed in that fund on the post 1 July 2026 asset amount. So again, what we've done is we've tried to build out some modeling with this, give you some timing around when you might be selling assets and values and growth and so forth, just to, again, help you to identify that. And again, the team's sort of building in some integration to drag some of that information down from Simple Fund 360. And the last one we're trying to do, which comes back to the very heart of that conversation that I was just talking about, is to really highlight with your clients the potential for this to come in based on the Division 296 tax laws. And this is where we have those two members, those balances are outside of the Division 296 laws, and thinking about, well, what happens here if the pension reverts? What happens if we take a lump sum? but keep it in super, or what happens if we pay that out? And again, start to model these different conversations that you might be having with clients, and then helping them to make some informed decisions about what that might all look like as well. And each time we have a summary at the end that provides a range of information there, and it allows you to export that out in Word, Excel, or even in PDF as well. So they're the three things that really stand out to us at the moment. And so I encourage people to kind of think through each of those from a liability point of view. Use Simple Fund 360 to not only get the data, but sort of run those calcs and understand that stuff. Really focus on that CGT election issue, because it is a live issue now. You should be clearly talking to clients if they've got non-traditional assets in there that don't have ready market things like valuations for properties, understanding and looking at the value of units in unit trusts, unlisted trusts. Again, we don't get the ability to uplift the assets within that trust, but we can uplift the value of the units that are held by the fund in that regard. So there's plenty of work that needs to be done now, not only to get yourself ready for these laws coming in, but for those conversations across those tier 1 and tier 2 clients in particular. And then the third, or the last bit, I should say, is then once you've gone through and you've really understood that modeling that's needed, and you've understood which way or which path your clients might be going, it's then a matter of, all right, well, what documents do we actually try to put in play here? And a lot of this is going to come down to the decisions that ultimately get made in this fund, and whether there are clients that are in scope or not. So from the CGT election, whether we're going to make that decision or not. And again, this is something that at Smarter SMSF we'll be building some stuff. I'm sure BGL will have some of their own documents to support you as well with these. But we have this ability for you to ensure that the specific requirements of the election are met, and then we document that decision accordingly. And again, we'll use the information that we have within Simple Fund 360 to populate that. It's very different to what we saw in 2017. I should note that 2017 election, if you did reset at that point in time, those deferred amounts are irrelevant for Division 296, but they are relevant when you sell the asset eventually within the income tax return of the fund. So CGT election is one thing. Clearly, pension flexibility. So we have a lot of clients that will have reversionary pensions. In a number of instances, they are going to be worse off by keeping the reversionary nature of that pension. Not in all instances, but there are certainly a range of instances, especially where they are not in scope, but would then move into being in scope. So again, making or looking at what those changes could be or should be off the back of that, and whether you can actually make that change midstream under the terms of the contract of that pension, or alternatively, whether you have to commute and repurchase. Now, one just thing to note, a lot of these clients that have built up significant wealth will have pensions that are quite old. And what I mean by quite old is that those pensions probably commenced prior to January 2015. Why is that number important? Well, that date is important because a lot of those clients probably have all those pensions exempt for getting the Commonwealth Seniors Health Card. And in that regard, last thing you want to be doing is commuting that pension and restarting it if you then have to tell your client that they're going to lose their Commonwealth Seniors Health Card at the same time. So be acutely aware of the date and timing of those pensions before you take any particular action off the back of it. And then I guess just a few other things there, just around, again, we're dealing with death benefits, how you might need to deal with the payment election authorities if they're making them as well. So from a deed point of view, we are making some specific changes to our deed, and you would see most others in the industry would be making similar changes at the moment. We're not going to release these changes, of course, until we've seen the finalised regulations. But we are seeing some changes to the way in which trustees are required to keep an account for records in the fund, which is our Rule 17. We are also dealing with the requirements of fund earnings and that attribution requirement, and that's where we're incorporating some stuff around the CGT election decisions that might be being made. We're doing an entire revamp of Rule 21, which encapsulates release authorities, not only for Division 296, but a range of others, Division 293 and transfer balance cap release authorities and the like. Family law gets some adjustments because of the TSB value definitions and so forth. And then more broadly, the definitions that need to be updated within the deed itself to deal with the Division 296 tax laws, the different thresholds that we now know exist, the reference amounts, the TSB values and the like as well. So it's not that every client is going to need an upgrade to their deed, but clearly you're going to have to spend time considering the appropriateness of the existing deed in light of those that might be in scope versus those that might move to be in scope, to those that might have reversionaries in place, but you want to change the structure of those documents so that you don't have to commute that pension and you can simply make a change to the terms and conditions of that pension. Looking at things like binding death benefit arrangements, and again, just ensuring that you're following very prescriptively the way that the deed is drafted. So again, putting in place the right building blocks off the back of a current deed. And then I guess the last one here that's worthwhile noting is a lot of you potentially haven't done a deed upgrade since 2016-17, when the superannuation laws, as we now know them with the reforms, were introduced at that point in time. And there have been a myriad of changes. And I think the one that stands out to me the most is the use of the technology neutrality measures. And that is the ability to sign documents in electronic form. Now, there are exceptions that we know, or exemptions that exist within the Electronic Transactions Act that allows for documents to be signed under the Corporations Act, to be signed from an income tax point of view. But if your deed doesn't provide for the ability to deal with certain documents in an electronic form, well, then potentially you are exposing the fund to not having followed due procedure if you're trying to do things like pension commencements and so forth that are not, or adding members and other things that fall under the auspices of the deed rather than the regulations or laws in their own right. So again, a number of things here that I just highlight for you to be thinking about around whether a deed update in this instance would be appropriate. It's nowhere near the extent to what we saw in 2017, where we saw a myriad of changes that needed, in essence, that upgrade to occur. But there are certainly a number of factors that would get you considering that. So again, this is what we've sort of got as our footprint around the document suite that would be relevant here. Whether you're making changes for commutation, you're looking at CGT elections, you're looking at reversionary pension amendments, and also updated deed requirements as well. And I guess finally, we've just put in here for you a checklist, so really a summary of information to understand what you need to be doing and when you need to be doing it. So really using that Simple Funds 360 data to allow you to clearly understand and articulate what clients are impacted, what clients may be impacted, and what clients we just need to put a watch on. We want to segment those into those relevant tiers. We want to start the communication process with our clients. We can then look to add real value to our clients by modeling some of this for them. And then we can look to put in place the appropriate building blocks around the elections, around deed updates where it's relevant, and the other documentation that needs to be in place. So what we've done with that Division 296 tax hub that I was talking to you about before is we, in essence, have both what we call our premium section and then our free section. So our premium section is available for our existing document subscribers, but we also have the ability for people to be able to access that through a sort of an annual or one-off, but annual, in essence, a one-off annual subscription or one-off purchase. So what this does is gives you access to those communications, the fact sheets, the client letters, gives you access to those modeling tools. And then as we see these changes come in, we'll be updating that information as well. And then when those documents become available, subject to whether you do that on a pay-as-you-go basis or subscription, you'll be able to take advantage of that as well. So that Div 296 hub, you can actually purchase access to that at $600. per annum in essence. What we do have here as I guess, an offer for everyone that was online today is if you did buy that, not only will you get access to the hub, but we have our Division 296 tax online masterclass, which is next week. We'll give you complimentary registration, which will also provide you with 4 CPD hours as well. So just, I guess, a quick navigation to show everyone what that looks like. So again, you come into our platform and we've got here all the relevant FAQs, the calculators and tools, the fact sheets we spoke about, the legislative references and so forth. So it just gives you an ability to come in and understand where things are at, to find out where the pieces of law are that you might want to be looking at more specifically, the FAQs that I spoke about before to be able to look certain things up. I spoke to the fact sheets earlier. I also spoke to the resources page as well, our legislation and documents, as I said. And these documents, as I mentioned, will be updating shortly to ensure that you can order. Just links back into our documents area, and the calculators, again, access to through here as well. So I think that pretty much takes me to the end. I'm just going to double check that that's right. But yeah, Anthony, I think that's pretty much it. I'm sure we've got a whole myriad of questions. So I thought I'd make sure I've given myself a little bit of time at the end here as well. As I said at the very beginning, I didn't want to spend time here talking about the legislative detail today. A lot of you will have heard that already. If not, I suggest you come to our masterclass next week and we'll fill your boots with that as well. So, but there's a lot of conversation that needs to be happening now. And therefore, what we've really focused on over the last few months from our SMSF days that we held in March was to give the right level of runway for you to start to have those conversations with your clients. And from there, it then enables you to be empowered to actually support your clients with what they need to do as they navigate what's a really complex area with a level of uncertainty on top of the uncertainty that they're getting off things like the federal budget as well.